Okay, good evening and welcome back everyone to our options education webinar series. My name is Tony Zhang. I'm the Chief Strategist here at OptionsPlay. And today I'm here to talk about a very special topic because it really encompasses the benefit of options and why many of us seek to utilize options in our portfolios. And that is primarily due to what we call asymmetrical risk. So today I want to break down what asymmetrical risk means, helping you compare something that you might be familiar with, such as buying or shorting stocks, and comparing it to options to really understand the difference and how we can utilize options to allow us to apply leverage in our portfolios, but do so in a way that has limited risk, because many times we understand leverage is what we call a double-edged sword, meaning it can work in your favor when you call the direction correct. It can really hurt your portfolio if you have the direction incorrect. But options allow us to really take the best of both worlds, to apply leverage when we're right and actually decrease the leverage and limit our risk if we're wrong. So I want to walk everyone through that process so that you can understand how this leverage process works, and also understand what the limitations are, because there are some limitations to utilizing leverage in your portfolio and utilizing options when you have a directional view. So we want to talk about what those limitations are, and I'm actually going to show you how you can reduce those limitations and have them work in your favor as much as possible. So those are the things we're going to break down here today. Now, before I get started, just a quick disclaimer. What we're discussing here today is purely for educational purposes. It is not a solicitation or recommendation to buy or sell any specific securities. And for those of you that are brand new to OptionsPlay, what I'll do today is I'm going to go through some education, and I'm going to show you a platform, OptionsPlay. For those of you that have never used OptionsPlay, or if you have not seen OptionsPlay, you can sign up for free, courtesy of the NASDAQ exchange, at optionsplay.se, which I just placed into your chat window. You can find your chat at the bottom of your screen. It gives you free access to the platform that I'll be showing you here today, access to bi-weekly educational webinars, just like the one you're on here today, and access to a free on-demand options video library to help you better catch up to all the education that we have already produced here for options trading. So if you want to go back and look at some of the previous webinars, whether you're looking to generate income, whether you just want a platform overview of OptionsPlay, you can find that all in the video library. And also, we send out weekly cover call and short put reports along with trade ideas, which I will actually walk you guys through in a little bit when we go through some of these bullish and bearish ideas in a few minutes. So with that, let's go ahead and get started. I'm going to try to keep this as short as possible from the perspective of I want to spend less time on the slides and more time going through real examples, because I think that's the best way to learn. So we're going to start off by talking about what are the differences between trading stocks versus trading options. It'll be fairly obvious as far as what a stock looks like, but I really want to make sure everyone understands buying calls and buying puts, the basic option strategies. Now, many of you that have some experience trading, you might say to yourself, I know calls and puts, but I want to put it in a context of really understanding the difference. And then because understanding the difference and also understanding the limitations of buying a call and a put. Because once you understand those limitations, then we can talk a little bit more about the advanced strategies, buying debit vertical spreads, and show you how we can take those disadvantages and try to turn them into advantages, or take away the disadvantages as much as possible. And then at the end, what I'll do is I will go through some option Greeks, walk you through the Greeks, because understanding the Greeks is fundamental to understanding how leverage with options work. So I'm going to break that down, and then at the end, we'll go through any more examples if we have time. So before I get started, if everyone can please just pull up your chat window at the bottom of your screen, and please type 1 if you currently trade options or have experience trading options, and please type 0 if you're brand new to options or learning how to trade options. Okay, so I have a pretty good mixture of 1s and 0s. I see a 2 over there as well, so maybe Jens, that means you're an expert options trader. So sounds like I have a pretty good mix of users who have some experience versus some who do not. So for those of you that are brand new to options trading, I hope that this inspires you to take a look at options trading as a tool for your portfolio. And for those of you that have experience trading options, this is really designed to help you, to give you a much better understanding of when you're choosing an option contract, whether that contract makes sense for you. Because what you're going to find is that even though there are options listed on a stock, that does not mean that you should always trade the option when you have a bullish or bearish view. And I want to walk you through that. So let's first talk about an individual stock, right? So here I have just the exact OMX 30 ETF. And for many investors, you have always the choice of, do I think the stock is going to go higher or lower, right? That's a very simple directional question you always have whenever you're trading any market. Right? Now, you can trade that directional view using the ETF. You can trade that directional view using stocks. So let's talk about the stock part first, right? You can either have a bullish or bearish view. And as a stock investor or an ETF investor, you can either buy the stock because you're bullish, or you can short the stock when you're bearish. Those are your only two options. Now, the benefit of this strategy is it provides immediate gains if the direction that you call is correct. So let's say you're bullish on this particular ETF and you believe the stock is going to go higher. So you buy it at 227 crowns, and if the stock moves to 228 or 229 crowns, you start to make money immediately. The second the stock starts to move higher, you make money. And we have what's called symmetrical exposure, meaning if it goes up by 2 crowns, you make 2 crowns a share. If it goes down by 2 crowns, you lose 2 crowns a share. Very easy to calculate P&L and understand what your exposure is when you're trading, when you're buying or shorting a stock. You can trade this on any time horizon, meaning once you buy the stock, you can hold on to it for a second, a minute, a year, a decade, however long you would like. The only limitation to stock trading is the fact that you have 0 neutral options, meaning if you believe a stock is near a resistance level, you don't think it's going to go much higher, but maybe you're not bearish on that trade, and you don't think the stock's going to move anywhere, you really can't trade a stock to be able to make money if it doesn't move. So you do not have any neutral options. So I think this part is pretty clear for most people, that stock trading is symmetrical exposure, easy to calculate your gains. You get and the most important part is the fact that you get symmetrical exposure. If everyone understands that, please type 2 into the chat window. Perfect. Okay, I see a lot of 2s. Great. So let's talk about buying a call option. A call option is a bullish strategy that allows us to utilize options to take a bullish view in the markets. And I want to break down this strategy. Even for those of you that have experience trading options trading, I want you to pay attention because I'm going to go over a few important things that you need to know in order to better understand the next strategy. So here I have an example of a stock that's trading at 100 crowns, and I believe this stock is going to move higher, right? So I think it'll go to 105, 110, 120, some price higher than the current price of the stock. So as an options investor, what I'm going to do is I'm going to buy a call option, right? And for now, we're not going to talk about expiration dates. We're not going to talk about anything like that. We're just going to break down the strategy itself. We're going to come back to talk about expiration dates and things like that later. This is just so that you understand the concept and understand the benefits and limitations of call options. So what I'm going to do is I'm going to buy a 100 crown call option. So I'm going to buy an at-the-money call option. And let's say this call option cost me 4 crowns to purchase. So what you're going to notice immediately is that with a call option, you're going to be able to control 100 shares of the stock for a significantly smaller amount of capital. So if you bought 100 shares of this stock, it would cost you 10,000 crowns or 100 crowns a share. To buy a call option only costs you 4 crowns a share. So 400 crowns to control 100 shares. So what that means is that immediately when you buy a call option, you have 25 times leverage in this particular case because you're controlling a 100 crown stock for just 4 crowns. And the benefit of this is that not only do you control this amount of stock for such a small amount of capital, you also can risk no more than what you've paid for that call option. So the benefit, one of the main benefits of trading options is that your risk is limited to what you've paid for that call option. In this particular case, 4 crowns per share. So if you have 100 shares, that's 400 crowns. No matter what happens, even if the stock goes from 100 crowns to 0 tomorrow, maybe this stock goes bankrupt tomorrow, you still only lose 4 crowns a share. If you had bought the stock, you would lose 100 crowns a share. So the goal here is to help you gain upside while maintaining your downside at a minimum level. So here, as you can see, my max reward is still unlimited. So if I'm correct and this stock moves higher, as the higher it moves, the more money I make. So the further to the right it goes, the more money I make on my call option. And there's no limit as to how much money I can make. So if the stock goes to 1,000, I can make a ton of money. And if the stock goes to 0, I only lose 4 crowns. Okay, so that's the asymmetrical risk that in any world we would like to have that call options provide us with. Now, I think up till now I've been talking about call options in a very favorable light, right? You get leverage. If it works in your favor, you get unlimited gains. If it goes against you, you lose only 4 crowns. So what's the catch? What's the downside? The downside is that when you are bullish on a stock, you can buy the stock, and as soon as the stock moves higher, you start making money. On a call option, that's not the case. Because I've paid 4 crowns for this call option, the stock needs to move 4 crowns in order for me to make money. So the stock actually has to increase to 104 crowns by expiration just for me to break even. So the stock needs to move 4% higher just for me to break even on the strategy, which means that it only makes sense for me to buy a call option if I think this stock is going to move 5%, 6%, 7% before the expiration date. If it doesn't move by that amount, I actually either break even or I actually lose money. And that's one of the biggest challenges of trading options, is that not only do you have to call the direction of the stock correct, you also have to call the magnitude. Meaning, if the stock only moves up 3% higher, and the threshold to make money here is 4% higher, and you don't meet that threshold, you've got the direction correct, but you still lose money. And that is always a tough pill to swallow for most investors. And for any of you that have traded an option before, called the direction correct, and still lost money, please type yes into the chat window if you've ever found yourself in that scenario before, where you bought a call option, the stock went higher, but you still lost money in that trade. If anyone has ever fallen into that category, please type yes into the chat window. So I just want to make sure everyone understands the limitations of a call option, because yes, it does give you leverage. Yes, it gives you unlimited upside while limiting your risk to only 4 crowns a share, but you have to call the direction correct and the magnitude in order to make money, which means that if the stock, this 100 crown stock, instead of going up, let's say the stock, instead of going up that you expect it to, just goes sideways. It doesn't move higher, it doesn't move lower. Guess what happens? You actually lose 4 crowns. You will have a max loss at 100 crowns or lower at expiration, because you paid 4 crowns for that call option. If the stock doesn't move any higher, you actually lose 4 crowns. And that's also tough to swallow, right? Saying that I think it's going to go up, but it doesn't go up, but it also doesn't go down, and you still lose money. That's the most difficult part about trading options, is that based on the price of that call option, you have to ask yourself, well, if a 100 strike call option costs 4 crowns, then you have to ask yourself, do I think this stock is going to move 4% higher between now and the expiration date? And if it does, if you do think it's going to move higher than that, then it's worth buying that call option. But if, let's say, you only think maybe it'll move 3%, maybe 4%, then guess what? It doesn't make sense to buy that call option. So you can get the direction correct and still lose money. And that's the most difficult part about trading options. Now, I just want to make sure, it sounds like everyone understands that, but I just want to make sure that that is the case. Please type yes into the chat window if that makes sense to you, especially for those of you that are brand new to options trading, because that is I would say, the most difficult lesson to learn when you're trading options. Perfect. So I see a lot of yeses. And I want to spend time on this because it's so important to trading options, because if you don't learn this lesson, ultimately in the long run, you're likely going to lose money from trading options. So we learned that overcoming the amount that the stock needs to move is one of the most difficult parts of trading options. So how can we help you with that? How can we use options to our benefit to improve that? And the answer is, the great thing about options is that there are a lot of options. So in this particular case, what I'm going to show you is what I call an improved a call option called a debit spread. So this is where we trade two options at the same time. Now, the reason, excuse me, the reason I'm going to introduce this strategy is because you can actually get the same benefit of buying unlimited upside, right? Because when you're bullish on a stock, right? In this particular case, I'm still bullish on stock XYZ, but maybe I just think it's going to move 5% and 6%. I don't think it's going to go 10%, 20%. So one of the things is that you'll notice that when you buy a call option, when I buy that 100 strike call option for 4 crowns, what I'm actually buying is unlimited upside. So before I talked about, if the stock goes to 1,000 crowns, I can make effectively 900 crowns on that trade. There's no limit as to how much money I can make. However, keep in mind that when you're trading an option, there's an expiration date, meaning when we say we're bullish, we mean bullish within a certain period of time. So you have to ask yourself, yes, I'm bullish on stock XYZ, but let's say I'm only trading a 2-month call option. How far do I think the stock can realistically go in 2 months? Maybe 10%, maybe 15%. I don't think it's likely going to make 100% move in 2 months. So why should I pay for all that upside? And the answer from options is that you don't have to. You can actually trade a smaller amount, or I'm sorry, you can do multiple things with options where I can buy upside and then sell off upside up to a certain point. So what I can do is, instead of just buying a 100 strike call option for 4 crowns, I can at the same time sell a 110 call and collect 1 crown. What that means is that I'm bullish on stock XYZ, but there's a limit as far as how far I think that stock can go. So what I'm going to do is I'm actually going to sell off any gains above 110 and actually collect some money to do so. Now, I just want to make sure that that makes sense to everyone, that you can buy an option that gives you upside. At the same time, you can sell an option to effectively give up any additional upside for some money. And when you do that, you're going to get some benefits. And I'll explain what those benefits are. But I just want to make sure everyone understands that you can buy an option, but at the same time, you can sell another option against that. So please type 3 into the chat window if that makes sense to you. Okay, so the goal here is to buy upside that you need and sell off any upside that you don't need. Because when you do that, this is what happens. So now, instead of paying 4 crowns for the bullish trade, because I'm collecting 1 crown by selling off anything above 110, now it's only costing me 3 crowns to control that same 100 crown stock. Which means that before, in the example I showed you, I controlled a 100 crown stock for $4, 4 crowns, so that's 25 times leverage. Now, guess what? Because I'm controlling the same stock for 3 crowns, now I have 33 times leverage. So I've increased my leverage so that if the trade goes in my favor, I'm going to make actually more money. I'm actually reduced my risk because what I pay for the option is how much I risk. So here I'm risking only 3 crowns. And the only downside to this is that I've capped my rewards. And basically, by selling that 110 crown stock call option, now the most I can make is 7 crowns. Now, how do I get to that number? The difference between the 2 strikes, so I bought the 100, I sold the 110, that's a 10 crown with spread, and I'm paying 3 crowns for it. So the rest of it is my max reward. So now, instead of being able to make unlimited rewards, I can only make 7 crowns. But you should ask yourself, in the first example, why would I want to cap my unlimited rewards to just 7 crowns? And the answer is that even if you didn't cap it, chances are you're not going to make much more than 7 crowns on that trade anyway, because the stock would have to go to, would have to make a 15% move in 2 months in order for you to do that. And that's just unlikely. So even though it doesn't sound very good on paper, most of the time you're not going to make those types of big moves in a very short period of time. It's better to reduce your risk. In this particular case, by reducing from 4 crowns to 3 crowns, I've actually reduced my risk by 25%. Imagine if you could reduce your risk on every single trade you make by 25%. How much would that improve your returns by? How much would that reduce your risk by? It's a significant amount, and most people don't think of it that way. So I hope that this changes the way that you think about your trades. And not only do I reduce my risk, improve my leverage ratio, it improves my leverage ratio. It allows me to take the same trade with less capital. I also improve my break-even price. So before, the stock needed to move 4 crowns or 4% in my favor before I broke even. So I would have to expect the stock to move 5, 6, 7% in order for it to make sense for me to buy that call option. Now, because I've only paid 3 crowns for this spread, my break-even price is reduced to 103. I've reduced my break-even price by 25%. Instead of having to go 4% to break even, now the stock only has to move 3 crowns or 3% to break even. So I've lowered my break-even price, which also means that I have a higher probability of making money on this trade, right? Because it obviously has a higher probability of moving 3% than 4%. So really what you're doing is you're really just improving your trade. And this is why I called the strategy an improved call option. I still have the same risk, meaning if the stock doesn't move, I'm going to risk 3 crowns instead of 4 crowns. But if the stock doesn't move, I still take on that 3 crown risk. But what I've done is I've reduced my risk. I've improved my leverage ratio. I've improved my break-even point, which means that I have a higher probability of making money on this trade in the long run. And the stock does just I don't have to be as bullish on that stock in order for it to make sense for me to buy this debit spread. Now, I know I spent a lot of time going through these 2 slides alone, but it's so important that everyone understands, what the benefits are of buying a call option, what those limitations are, and how you can improve those limitations by trading a debit spread. So I want to make sure everyone understands this before I move over to showing you some examples. So please type 4 if all of this makes sense to you. And I will show you an example here to hopefully solidify this a little bit. And for those of you that are saying, how do I come up with some of these ideas myself? I'll go through some of the newsletters that we've been sending out every single Friday. But I'm going to start off by talking about, let's use AstraZeneca as one of the examples here. I was using AstraZeneca earlier today. I was looking at this stock. This is a stock that happens to be traded in the US as well. So it's a stock that I'm somewhat familiar with, and I wanted to take a look at it because the stock has relatively strong relative strength. It has a strong relative technical score, which means that it's a strong relative strength. 1 month and 6 month trend is bullish, typically what I'm looking for in order to make a bullish view on a particular stock. And, to my eye, this stock spent a lot of time trying to break above that 950 resistance level. It made an attempt here in late October, made an attempt there again in late December, made an attempt again in early January, and finally broke out above that 950 level, pulled back a little bit to retest that level, and so far has bounced off today. So my expectation is that maybe if I just draw this a little, make it a little clear. So that was the resistance level that I saw the stock struggle to get above, finally managed to break out above it, came back to retest it, and my thesis is that I think the stock is going to move higher. So how can we take advantage of this? Let's take a look at using OptionsPlay to help us determine how to play this bullish view on AstraZeneca. And again, this is just my personal opinion on this particular stock. Now, using OptionsPlay, one of the beauties of this platform is that you can type in any symbol, click on either I'm bullish or I'm bearish, and we'll show you 3 strategies to learn how to trade options. So we talked about buying a stock, we talked about buying a call, and we talked about buying a call spread. And that's what OptionsPlay automatically selects for you. And not only do we select the strategies, we also select the expiration dates and strike prices. So I don't have enough time today to get into the best practices for selecting expiration dates and strike prices. That is something that we will cover on future webinars. but the tool applies what I'm going to teach you on those webinars directly on our platform. So even if you don't learn them today, you still have access to the same information, because buying 100 shares of this stock will cost you 96,000 crowns. Buying a call option, as you can see, cost you only 3,000 crowns. So slightly different numbers, but the stock is close to 1,000 crowns, a fairly expensive stock from Swedish perspective. A call option here only costs 3,000 crowns, so roughly 3% of the underlying stock price to control the same 100,000 crown position. And as you can see, this call spread, the vertical spread, the debit spread that we talked about. So in this particular case, I'm buying the March 20th 960 strike call option because the current price of the stock is 961 crowns. That's why we're buying the at the money call. And if you look at this call spread, what I'm doing is I'm still buying that $960 call option that we talked about in our example, but what I'm going to do is I'm going to sell off a higher strike price. In this particular case, we automatically select the 1,050 strike, collecting 3.5 crowns. So I'm spending 3,000 crowns to buy the call option, but I'm going to sell off any upside above 10,050 for 3.5 crowns. So I'm bringing in exactly 10% of the underlying stock price. I'm sorry, the underlying call price to reduce it from 3,000 crowns to 2,700 crowns, right? So what I'm going to do is I'm going to show you these strategies side by side so that you can actually better understand how you can utilize these strategies in your portfolio. So I just want to make sure everyone sees this, right? We're looking at the March 20th, which is 58 days away, roughly 2 months away. We're buying that call option just like the one we are doing here in the middle, but instead of just buying a call option, which gives us unlimited upside, we're going to sell that 1050 for 3.5 crowns. And let's see how these strategies perform. So first off, I'm going to, just because I always like to start off talking about risk first, right? So let's say I'm bullish on AstraZeneca. It's above that 950 key level that I'm talking about. But what if I just get this incorrect and the stock plummets? Let's say it plummets back down to, it traded within this range down to about 900 for quite some time. So what if I get this completely wrong and AstraZeneca tanks to 900? If you had bought 100 shares of this stock, you would lose 6,250 crowns. If you bought this call option, you would lose 3,000 crowns. So you would actually risk half as much if you bought the call option versus the stock. And this is really your starting point, is understanding how much risk are you taking versus this spread here on the right. Even if you know nothing about options and you don't know what a debit spread is, and today is the first time you learned about it, you can see that even if you get the direction of a stock call, and people get directions wrong all the time. I would say that any good trader is still going to be wrong 30-40% of the time, right? So you have to make sure that you plan for that when you're wrong, you don't blow up your whole account. And options allow us to control how much risk we have, because no matter what happens, even if the stock goes to 800 crowns, I'm still limited to the 3,000 crowns on the call option and the 2,700 crown loss on the call spread. Versus on the stock option, on the stock leg, the more the stock goes lower, the more I lose. So the first part is about controlling your losses. So as you can see here, if the stock goes against me, I lose the least amount of money on this strategy here on the right-hand side. So now let's talk about, what if I'm right? What if AstraZeneca takes off, right? So and there isn't a lot of a template here as far as where the stock can go, right? The stock does report earnings in 22 days, so maybe that could be the catalyst it needs to really push higher. But realistically, looking at this price history, I don't think that it can move more than 100 crowns, maybe higher. So let's say it goes from 960 to 1060. So let's take a look at how these strategies perform. So if the stock goes from 960 to 1060, I make $9,700 crown profit on my almost 100,000 crown investment, which is a 10% return. Here I make less profit, but because remember, I put up 3% of the capital to get into this trade. So as you can see, what happens is instead of making a 10% return, I'm making a 227% return. And this is the leverage ratio that we're talking about, is increasing leverage when we're correct. In this particular case, that leverage turns my 10% return into a 227% return. And then, as you can see, that 10% reduction in savings from 3,000 crowns to 2,700 crowns, what that does is it even goes a little further. Now, keep in mind that I sold the 1050 crown spread, which means that I'm capped in terms of how much money I can make above 1050. So if, let's say, the stock only moves up to 1050, notice how I can make a significant gain from the call option versus the call spread, 195 versus 233. The benefit of the call option is that it has unlimited upside, right? So if the stock keeps moving higher, it's going to continue making more and more money, versus when I buy a vertical spread, it's capped, right? Because I sold off anything above 1050, even if the stock goes to 10,000, I'm still only going to make $6,300 profit, 6,300 crown profit. However, you have to ask yourself, realistically, how far do I think this stock will go between now and March? And the answer is likely, the reason that we selected that 1050 strike for you is because there's a relatively low probability of the stock going above that price. So we're already doing that work for you. So this tool is really designed to allow you to quickly type in any symbol. Another one I was looking at is JM, trading at about a much more reasonable 280 crown stock. This stock broke out above that 270, 275 level. It's really consolidated a bit during that time because of the fact that it has a relatively neutral technical score. I'm not as bullish, but I actually think that this stock maybe has a higher probability of moving higher. It does trade at a substantially lower valuation than AstraZeneca. So my belief is that I think it's going to move higher, but I'm always prepared that I could be wrong and this stock can pull back. So if I'm looking at this particular name, then 2,800 crowns to buy 100 shares of the stock, only 1,275 crowns to buy a call option. And here the vertical spread, I'm still buying the 280 call like I'm doing here, but I'm going to sell the 310 call against it and collect 2 crowns, reducing my risk from 1,200 crowns to 1,070 crowns. And what I can do is I can say, well, what happens if the stock moves up to 300 crowns? If I bought the stock, I'm looking at a 7% return. If I bought the call option, a 56% return. If I bought the call spread, an 86% return. And that's why the strategy on the right has the highest OptionsPlay score, because if I'm correct on my trade, I make the most return. And if I'm wrong on my trade, if the stock plummets back down to 260 or let's say 260, here I lose 2,000 crowns. Here I lose 1,200 crowns. Here I lose 1,070 crowns. So it's really designed to allow you, for anyone, even if you know nothing about options, to plug in a symbol, be able to quickly look at starting points for both stocks, options, beginner option strategies, more advanced option strategies, and be able to utilize a P&L simulator and see, well, how much money would I make if the stock went this much higher or this much lower, and immediately know whether this is the right trade for you. So with that, what I'll do is I'll go back to options, to the slides. What I want to do is I just want to quickly walk through a bearish trade, but to be perfectly honest, I don't think we need to spend a lot of time because it's just a mirror image of the bullish trade. So let's say I'm bearish on stock XYZ, 100 crown stock. I think the stock is going to move substantially lower in this particular case now. So what can I do? You can buy a put option. A put option allows you to profit as long as the stock moves lower. So buying a 100 strike put option for 4 crowns means that I have 25 times leverage because, again, I'm controlling a 100 crown stock for just 4 crowns. My max risk is 4 crowns. My max reward is unlimited down to 0. So if the stock keeps going lower and lower and lower all the way down to 0, I make more and more money on this put option. My break even on the strategy is 96 crowns because I paid 4 crowns for this put option. The stock needs to move 4% lower or 4 crowns lower in order for me to make money on this trade. So that's the challenge here, is that not only do I have to identify bearish stocks, I have to identify bearish stocks that I think is going to move more than how much I'm paying for that put option. And I have a max loss of 4 crowns if the stock stays at 100 crowns or higher at expiration. So again, if you understood the call option, you should understand the put option. But before I move on, please type 5 if the put option side makes sense. It is just the exact mirror image of the call option. So if you're still feeling that this is new to you, these webinars are recorded. The slides are made available to you. I recommend that you take the time to learn about call options a little bit more, watch the recording, and then come back to the put option and just think of it as the mirror image for a bearish view. So for put options, you have the same choice as you do with the call options where, whoops. Oh, I have the wrong graphic here. I'm sorry. I have a call option graphic here. So this should be reversed, but effectively, and I will fix this before I send this out, but on the put option side, you can buy the same 100 strike put for 4 crowns, but again, when we're bearish on a stock, we probably don't think the stock is going to zero between now and expiration. So if you buy a 2-month put, I doubt you believe that the stock is going to zero in 2 months. So why should you pay for all that downside? And the answer is you can buy the 100 crown put, but sell a 90 crown put against it and collect a 1 crown credit for it. And net, instead of paying 4 crowns for that bearish trade, only paying 3 crowns for that bearish trade. Here, you've reduced your risk from 4 crowns to 3 crowns, which means that you've increased your leverage ratio from 25 to 1 to 33 times to 1. You have capped your max reward at 7 crowns, but you should ask yourself, even if I didn't cap my rewards, how much money could I have made on that individual trade? And the answer is you probably might find that it's not as much as you would think. And what you've done here is you've improved your break even. So instead of having the stock to move 4 crowns lower to make money, you only have to move 3 crowns lower, which improves your probability of making money on this particular trade. And your max loss stays the same. If the stock is at 100 crowns or higher, you would lose 3 crowns instead of 4 crowns. So again, mirror image of the call options that I just showed you, but I just want to make sure everyone understands that before I move on to the next slide. So if this makes sense to you, please type 6. And again, I apologize. I used the call option image here, but I will fix that and send you the put option image in the slides. So please type 6 into the chat window if the put option side makes sense to you. Okay, perfect. I see a lot of 6s. Great. So now what I want to do is I want to talk a little bit about this, we talk about buying that 4 crown call option, right? And we say that if the stock moves up 10 crowns, you make a certain amount of money. And OptionsPlay does the calculation for you, right? I just showed you using this P&L calculator. If the stock goes up by a certain amount, how much money do you make on your call option or your call spread? How much money do you lose if the stock goes lower? We do this calculation for you. But that doesn't mean that you shouldn't know how that calculation is done. So I want to introduce a thing called the option Greeks. And this many times scares people away because the Greeks, whenever you try to Google this or look it up yourself, you see that it involves a lot of math and involves a lot of formulas with things that you may not understand. So I don't want to scare you off, but I want to make sure that everyone understands from a conceptual perspective how this works. So there are 3 Greeks that are really important to understand. Delta and theta are, in my opinion, the most important one, but I also want to introduce one called gamma because gamma helps us understand this asymmetrical risk, right? Because, I'm telling you that you get higher and higher leverage as the stock goes in your favor, right? You make more and more money as the stock goes in your favor, but you have limited risk to the downside. How does that magically happen, right? How do you just get more and more money if you call it correct and have limited losses if you're wrong? So it's really important to understand how the option prices work so that you have a better understanding, in my opinion, to be able to trade this. So I'm going to talk about delta first, which is the impact of the directional move on the underlying stock and leverage. So delta tells us how much the price of the option that you own will change based on the change in the stock price. So in any example, and I'm going to use Saab here for an example that's currently trading at 300 crowns. And the question is that if you buy a call option on Saab and the Saab goes up by 1%, how much money do you make on your call option? So delta of our option tells us how much money we can expect to make if the stock goes up by 1 crown. And so in any particular case, every option has a delta, and the delta tells us how much money we should expect to make on the option with a change in the stock price. So if you see an option that has a delta of 0.5, what that means is that if the stock moves up or down by 1 crown, your option will move up or down by half a crown. So the 0.5 is the ratio of which the stock moves versus the option move. So if you buy a call option on SOB, and let's say SOB is currently trading at 300 crowns, and over the period of owning that call option, the stock goes from 300 to 303 crowns. So it moves 1% higher. So if the stock moves up 1%, how much money do you make on the option? And the answer is you take the delta multiplied by the change in the stock. So in this particular case, the stock went from 300 to 303, so that's a 3 crown move. So you take 3 crowns, multiply it by 0.5, and that tells you how much money your option will increase by. So in this particular case, 3 multiplied by 0.5 is 1.5. So your 15 crown option that you paid for this SOB call option will increase from 15 crowns to 16.5 crowns, which in this particular case is a 10% gain. So that 1% gain in the underlying stock turned into a 10% gain in your option. So that's how you can use delta to calculate roughly how much money you would make if the stock went 1% higher, 1% lower, or 10% higher, or 10% lower. So, again, this is somewhat theoretical, and this is more so for you to understand the concept. You don't have to know how to do the calculations because OptionsPlay does the calculations for you. But I want to make sure everyone understands delta because it's one of the most important Greeks to understand, and it will come into play in other lessons in the future. So delta, in my opinion, one of the most important Greeks to learn when you're trading options. So if everyone understands this, please type 7 into the chat window. Perfect. Okay, I see a lot of 7s. So now let's talk about theta, because option contracts have an expiration date, right? So we talked about a March expiration in the AstraZeneca and the JM example that we talked about. So one of the things, and this is one of the more difficult parts to understand about options, is that as an option contract approaches the expiration date, it actually decreases in value. Now, the stock decreases in value, and the problem with the decrease in value is that it doesn't decrease in value in a straight line, meaning it's not like from 2 months to expiration, it decreases by the same amount. The decrease actually happens more like this. It's a curve. So it happens at first really slowly, and then as it approaches expiration, it gets faster and faster and faster. And near expiration, it actually erodes much, much quicker. So this erosion of the value of your option as time goes on is expressed by a Greek called theta. Theta tells us the change in the option price with respect to time. And theta actually accelerates as you get closer to expiration, which is another thing that we need to learn more about. But for now, let's assume that it's fairly constant, meaning over a short period of time, theta is generally constant. So if you have a theta of 0.05, what that means is that this option that you own will lose 0.05 crowns per day. So in the previous example, we talked about buying a call option on SOB, which is currently trading at 300 crowns. And we talked about before, if SOB went up by 1%, how much money would you gain from the stock? But now let's add one more element. What if this stock went from 300 to 303 crowns, but it took a week for that stock, for that 1% move to happen? So what we need to do is we need to look at two variables. Number one, if the stock moves from 300 to 303, in the previous example we calculated, that means that the stock moves from 15 crowns to 16.5 crowns, which is a 10% gain on the underlying stock. But we also have to factor into the fact that the value of an option erodes as time goes on. So in a 1 week time, if the theta is 0.05, so 0.05 times 7 days gives us an erosion of 0.35 crowns. So what we have to do is we have to subtract 0.35 crowns from the 1650, which means that the value of that option erodes from 1650 to 16.15. So now the total gain, instead of being a 10% gain, is only a 7.6% gain, because yes, the stock moved in our favor, which is good for the value of our option, but a bit of time went by, which erodes our option. So delta and theta are the two most important Greeks to understand, because Those are the two things that predominantly is going to affect the value of your option. If you're buying an option, you obviously want the stock to move in your favor, but you need that move to happen in a relatively short amount of time, because if, let's say, this took 2 months to happen, then you can have all of your gains that you received on the underlying stock be eroded from the value, from the time value. So there's two factors that you really have to think about when you're trading options: is where do I think the stock's going to move, and how long do I think it's going to take? The longer it takes, the harder it is to make money on the options. So that is, in my opinion, the most difficult part of trading options. And lastly, I want to talk about gamma. So in the example before, we talked about if the stock moved 1% higher, you should expect to make 1.5 crown on your call option in SOB. However, we talked about this in the very beginning, right? We talked about a call option giving you this type of payoff that gives you leverage if you're right, but limits your risk if you're wrong. Now, how does that actually happen? The answer is gamma. What gamma does is it actually changes delta as the stock goes in your favor or goes against you. So how do we actually get this limited risk to the downside but still have unlimited gains to the upside? It's because delta actually changes as the stock goes in your favor and goes against you. And gamma tells us how much delta changes by. So if you have a call option of a gamma of 0.02, what that tells you is that delta will increase by 0.02 for every 1 crown the stock changes by. So to give you a better example of this, so in the same example, SOB B, which is where is currently trading at 300 crowns, let's say the stock either moves 3 crowns in our favor or it moves 3 crowns against us, right? Those are the two possibilities, right? It can either go in our favor or against us. Now, if it goes in our favor, what happens is gamma actually increases our delta. So if the stock goes in our favor, not only does the delta, which gives us gains in the underlying stock, it actually gives us bigger gains as the stock moves higher. So if the stock goes from 300 to 303, not only does the delta give us gains, it also increases delta. So if the stock moves another 3 crowns higher, so if it goes from 300 to 303 and then goes from 303 to 306, what happens is that in the original one, we made what did we say, about $1.50 on the first, 1.5 crowns on the first 1% move. On the next 1% move, it's going to make more than 1.5. It's going to make close to 1.7. And the further it goes, the more you make for that same 1% move. So maybe by that, you make 2 crowns for. And what happens is your leverage ratio continues to increase, because as the stock goes in your favor, gamma is going to increase delta. And delta can go all the way up to 1. And when it reaches 1, you get dollar for dollar exposure in the underlying stock. Now, the great thing about this is that it works against you in the other direction. So if the stock moves lower instead, it actually decreases delta. So we talked about it. If the stock goes from 300 crowns to 297, you lose maybe $1.50, 1.5 crowns. But if it moves from 297 to 294, another 3 crowns, then instead of losing 1.5 crowns, you might only lose 1.3 crowns, because gamma changes the leverage ratio. And when it goes in your favor, it increases your leverage. And when it goes against you, it decreases your leverage. Now, this is as difficult as it will get with respect to learning the Greeks. And it's not intuitive, and I know that, but that is really how you get this curve that looks like this in the long run, because gamma, what it's doing is it's constantly reducing leverage as you get it more and more wrong, and increases your leverage the more right that you get. And I know that sounds really weird, but the more right you are on the direction of a stock, the better delta gets for you and improves your leverage ratio. And the worse and the more wrong you are, the less leverage, it actually decreases your leverage. And it's somewhat counterintuitive, but gamma is actually what allows you to achieve this asymmetrical risk. So with that concludes what I wanted to show you here today. I know I covered a lot of things But I really think that this is the most important stuff to learn, especially for those of you that are beginners, to understand the concept of trading options and not just jump into it with a bunch of numbers, not really understanding what you're doing. So with that, I just want to thank everyone for taking the time out here this evening. And I hope that you guys learned something here today. And at this point, what I'll do is I'll open this up for Q&A. So if you have any questions, feel free to type them into the chat window. But again, I just want to say for those of you that are brand new, if you have not signed up for OptionsPlay, I highly recommend you to do so at optionsplay.se. And I hope that you are able to utilize this tool. Type in a symbol, any symbol that you want. I was looking at Husqvarna actually because we were bearish on this particular trade for a while, but the stock went a little higher. But I think this might be returning back to maybe a bearish opportunity again. So you can really utilize this tool to pick any symbol, select either bullish or bearish, and instantly be able to compare strategies side by side. I know I didn't get enough time to go through a bearish example here today, but really, again, the bearish side is just a mirror image of the bullish side, and I genuinely, if you're bearish on a stock, I recommend you to buy a put option because the call options, shorting a stock gives you unlimited risk. Buying a put option caps your risk to the amount that you pay for that put option. So if you're ever bearish, I recommend that you take a look at put options versus shorting that stock. So any questions regarding the tools? Very good. When is the next one? So the next one is actually next week. However, that is not hosted by me. That's hosted by the Options Industry Council, which is a great learning tool. They are a free organization here in the US that provides just education. I really recommend that you take a look. It's being taught by a good friend of mine named Gary Delaney, who's based in London. So I highly recommend that you guys register for that. We will send out an email tomorrow on registration for the next educational webinar, and I will be back here in about 2 weeks. And I'm really excited because in 2020, we're going to change up the education a little bit. We're going to create these miniature courses so that we're going to group a few of these webinars together so that you're not just getting 45 minutes of content on a topic, you're actually getting an hour and a half. You're getting 2 of them. And what we're going to do is we're going to do another 45 minutes after that to just spend time going through real examples, because that's, again, what I think is the most valuable tool in learning it. The PowerPoints are really useful in helping you understand concepts, but I think where most people learn is actually when I go through examples and show you real stocks and real bullish, bearish examples and show you how I would utilize the tool for trading. So in 2020, what we're going to do is we're going to group 3 webinars together. We're going to show you how you can learn different concepts and then spend a whole webinar just on implementation so that you can see how we utilize options in our practice. So one question is here, are they using the mid prices between the bid and ask? Great question. So on any trade, you can click on modify and you can select either the bid ask price or the mid price. So you can price these both on both the bid ask or the mid price. You have that option, so you have the understanding as to what might be your best possible execution at the mid price and what is your worst possible execution at the bid ask. Frederica is asking, next time, could you please explain how the options idea examples work? So great question, actually. So why don't I cover that for real quick? So Frederica asked a question. So you should have received an email like this last Friday if you have registered for an account. So what we're doing now is we're sending out trade ideas, right? So I showed you JM. This was one of the ideas that we sent out last week. So what we're doing is we're picking stocks that we believe have either a bullish or bearish view on the markets. Very similar to what I just showed you here today. I looked at a JM. JM is a strong stock from a relative strength perspective. Also has 1 month and 6 month trends that are bullish. Whoops. So that's why we selected JM as a potential bullish candidate. And then what we do is we also update you on the trades that we sent out in previous weeks. So we have 2 open trades in SAN and Secure UB. And then we also tell you which trades that we're closing. So in a few weeks ago, we had sent out an Electrolux trade and an Evo trade, both of which, the Evo trade was up 67%, so we recommend closing that out and taking profits. The Lux B trade was down about 35%, so we recommend closing and cutting losses. So it's really new trades up here, like JM. This is a new trade that we sent out on Friday. Sand and SU were previous trades, but we're keeping them open. And the last two are previous trades, but we're saying it's time to close them out, either at a profit or a loss. So this is really designed to give you ideas beyond just, giving you the platform, right? Because a lot of people come to us and say, okay, I understand how to use OptionsPlay. I understand how to analyze trades, but how do I find opportunities? And that's what we did this newsletter for, so that you can see what opportunities we see in the markets, so that you can look for yourself and decide whether or not you agree and choose to trade one of those on your own. So I hope that answered your question, Frederica. Bo Anders is asking, have you had one webinar already? So I've actually done, Bo, quite a few webinars. You can actually go to our options education page, which is available here. Let me send this to you. So if you want to view our previously recorded webinars, you can find them here on our education page, which I just posted a link into the chat window. Someone's asking about Baidu puts. So this is limited to just the Nordics, so I'm not going to comment on US or other securities on this webinar. Frederica, you also sent out a long list. I'm talking about the reports. So Frederica, the reports are more so for if you're selling cover calls or short puts. So, I covered a webinar here in, let's see, what day was that? I think it was the last one. Yeah, January 8th. If you want to learn how to sell cover calls and cash secured puts, I highly recommend you to take a look at that webinar, Generating Income with Options. So in that webinar, I teach you how to use cover calls and cash secured puts to generate income in your portfolio. Now, the cover call report and the short put report are basically implementations of those strategies. So if you want to sell cover calls, this will give you a list of the top cover calls to sell. If you're looking to sell cash secured puts, this will give you a list of the top cash secured puts to sell, and it sorts it by the annualized return. So this gives you an understanding of where are there opportunities to generate income from selling call options on stocks that you own, and where to sell short puts on stocks that you want to purchase. So if you don't know what these reports mean, I recommend you to watch that webinar recording from January 8th. Is it the strategy for a live trade? I'm not sure what you mean by is it the strategy for a live trade? All of these strategies are for live trading. Bo is asking, can I use this program if I go to the United States on vacation? Yeah, absolutely, you can. Frederica, you're welcome. Any other questions? I own the put. It is well in the money. Should I sell the put? One figure lower than the one I own. What do you mean by one figure lower than the one you own? If you bought a put for $1 and it's now trading at $2, then yes, you should sell your put for $2 and take that $1 profit. Hey, regarding your question about Baidu, again, I'm not here to comment on US options here. So if you don't mind, send me an email at info@optionsplay.com, with exactly what you're doing, and I'll take a look at that. Any other questions? There's a question here about, are all trading costs updated online? So your trading costs are based on your brokerage firm. So I don't know who you trade with. So you should ask your brokerage firm what your costs are to trade these options. We are working in 2020 to integrate some of that information into the education here, but as of right now, I don't have the commission schedules for your brokers. We are working on that. So that is coming soon. But for now, you're going to have to contact your broker to ask them about what your trading costs are. And if there are no other questions, I just want to thank everyone for taking the time out here this evening. I hope that you guys have found this useful. Please continue to take a look at the education page for the recordings. I hope that the weekly emails are helpful for you in terms of better understanding opportunities in the market, and these webinars are helpful in helping you understand the strategies themselves and how to implement and utilize this platform. You know, as we are always here to continue the education for you throughout 2020. Like I said, we've got a lot of great education coming up in the next few months. Really looking forward to having you guys there. So I will see you in about 2 weeks. But again, next week, a friend of mine, Gary Delaney from the OIC, will be teaching you some more education. He's actually going to be back for 2 weeks between, I think, next week and the week after mine, so that we're really trying to increase the education so that you guys not only get my perspective, but also other people's perspective. It's really important that you get a better understanding from multiple participants. So thank you so much. I hope you guys have a great evening, and I will see you in 2 weeks.